Good morning, everyone. Thank you for attending the Place Your Trades Network spaces to discuss shipping, ESG, and alternative investments. This spaces is brought to you by TraderMate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can now trade these on the DOM on TraderMate's main platform as well. It's a great way to get exposure to the futures markets with limited risk. You can use the link in my Twitter stream to go get the TraderMate app for free. I also write a weekly blog and daily pre-market overview on markets that you can subscribe to at placeyourtrades.com. And I'll be doing a summary of this episode with my key takeaways that'll be available as a PDF. So if you're interested in getting this PDF, click on the link in my feed or visit placeyourtrades.com/spaces to sign up for it. I'll also tweet it out and put it in the nest. And the PDF will be available and emailed out to anybody that signs up. So to introduce our guests, first we have Mark Yusko. Mark is the founder and CEO and chief investment officer of Morgan Creek Capital Management, LLC. Prior to forming Morgan Creek in 2004, Mr. Yusko was president, chief investment officer, and founder of UNC Management Company, the endowment investment office for the University of North Carolina at Chapel Hill from 1998 to 2004. Until 1998, Mr. Yusko was a senior investment director for the University of Notre Dame Investment Office, where he joined as the assistant investment officer in October of 1993. Mr. Yusko is the president and chairman of the investment committee of Hesbro Yusko Scholars Foundation at the University of Notre Dame, and president and head of the investment committee of Morgan Creek Foundation. And next we have Robert Mullin, who hopefully will be up here soon. Robert is the founder and general partner of Marathon Resource Advisors, LLC, and has been investing in the energy and national resource sector since 1994. Over the last 3 decades, he has been a portfolio manager at Franklin Templeton, the Cypress Funds, and Tocqueville Asset Management, as well as running his own firms focused on the sector. His thoughts on energy and natural resources have been featured in Bloomberg, Barron's, Wall Street Journal, and numerous other publications. He's recently appeared in interviews with MIO Global, Prometheus, Altus, and Crux Investor, as well as published in several videos on the topics of energy transition and the role of commodities in geopolitics. And last but not least, we have Ross Kennedy, who's the founder of Fortis Analysis. Oh, I can't speak this morning. A strategic consultancy that serves public and private sector clients operating at the nexus of global geoeconomics and national security. He's a logistics industry veteran with 17 years of direct experience operating in agribusiness, chemical, energy, humanitarian, food, defense, and water supply chains. So welcome to all of our guests. Hopefully MRA will get up here. So we'll begin. We'll start with the questions. Mark, I'll start with you first. First, I kind of want to talk about the big elephant in the global markets room, being China, particularly for those focused on commodities. So I want to talk about, is this property implosion a controlled demolition, i.e. pricking the bubble on purpose, or are things a lot worse in China than China may be reporting, which then may be followed with a global contagion?
Yeah, I always go with the simpler answer when it comes to China. China doesn't do anything that isn't planned. You know, they are on a 30-year plan. You know, they're pretty amazing when you think about how they can stick to a discipline over 3 decades, and they've been doing this 4 decades. And we in the West don't like it. You know, we don't agree with it. We don't believe in command and control economies, even though we're more closely aligned to that than we probably admit. It's kind of like, you know, we make fun of Europeans for taking August off, but so do Americans. We just don't talk about it. And so, you know, China took 700 million people out of poverty over the last 30-year plan. This 30-year plan is very different. So that first 30-year plan, which ended a couple of years ago, was really designed as what was called a harmonious rise. They wanted to create a moderately prosperous socialism economy. And by all measures, they achieved that spectacularly. And now we're all, we meaning the West, pointing at it saying, yeah, but look, they've got this property bubble and it's going to implode and it's going to take down the rest of the world. Well, the American property bubble exploded in the 20s and didn't take down the rest of the world. And Japanese property bubble imploded in the 70s and didn't take down the rest of the world, or the 80s, I guess. And this one won't take down the rest of the world either. And I love your term, Tracy, controlled demolition. It's exactly what it is. And there is a system in the way the party works. The party is very large. There's 80,000 senators in the party, and they all have their hand out, and they all get gifties in terms of land, and they use that land, and they sell it to developers, and then they pocket a profit, and then the developers profit by selling back to SOEs. And so it was a, pretty, some would call it corrupt, some would call it very planned system for a long time. She came in and said, well, there's too much power in these local authorities. I'd rather have it all with me and my cronies. So he dismantled much of that kind of systematically over the last decade. And you've seen them take down some of the most powerful people and companies. But all the while, the 700 million people in the middle class keep rising up the ladder. First they buy air conditioners. Every time you buy an air conditioner, you take 11 pounds of metal off the markets. And that has implications for things like copper and zinc and molybdenum and all kinds of things. And look at what they do to the grain markets around the world, commodity markets broadly. And they just keep accumulating assets and things. And as you move up that food chain from buying an air conditioner to buying an apartment to buying a computer to buying a scooter to buying a car, that is good for consumption. And I think and I'll stop talking. The biggest problem that I see is the Western world is fighting the wrong battle. It's like, the Trump tariffs. Tariffs were not a good idea when Smoot and Hawley created the dumbest plan on planet Earth back in the 30s. It wasn't a good plan here. And the reason it's not a good plan is you're fighting the wrong battle. It's not about made in China any longer. It used to be. 20 years ago, a friend's daughter came to him and said, Daddy, I thought you said Santa Claus brings the presents. Said, well, honey, he does. Why? Well, why do they all say made in China? So yeah, 20 years ago, it was all about exporting our low-paying jobs and pollution to China. They became the manufacturing hub for the world, just like America was after World War I. And we had all the pollution, we had all the low-paying jobs and chained kids to sewing machines, et cetera, et cetera. We forgot all that. And now China is migrating from that manufacturing place to the greatest consumptive force in the world. They have 700 million people who are going to consume like the world has never seen. And so now it's about made for China. What you want to do is make things that you can sell into those markets. So I'm actually pretty wildly bullish on China and growth equity and the opportunities there. And we've had an office on the ground there for 20 plus years.
And then how should we look at, Bloomberg just had an article out today saying there's a mass exodus of investors from blue chip stocks there, 11 billion in, a recent record sell-off. So how should we look at this? Should we look at this as, an opportunity, or do you think this is set to continue? As investors, how should we be looking at these
Well,
kind
look
of
at it for
figures?
what it is. Again, great question. It's propaganda, right? Same propaganda that we've been spewing for the last 4 or 5 years since we decided that Cold War 2.0 needed to begin, and we needed an enemy, and we were tired of being enemies with the Russians, so we picked the Chinese. And the amount of propaganda that comes out every day is staggering. For example, right, we're supposedly having all these tariffs, and we're supposedly being hard asses against the Chinese. We just set the new record for imports from China last month. I mean, it's just silly. We turns out Americans like buying cheap stuff. That's what we're good at. So we talk a good game, and yes, $11 billion on a multi-trillion-dollar market. It's just not a big percentage. And yes, the Western media is really good at finding little things to write big stories about over and over. And we've been talking about this VIE structure thing where you don't really own the company in China because of this offshore structure. We've been talking about that for 10 years. And we were going to delist all the Chinese companies, and people were going to divest. Now, it is actually happening. We have a client who completely divested of Chinese equities. I don't understand it. I tried to talk him out of it. Not successful. I think it's pretty amazing to me that you would take that stand and divest from the second largest market in the world, right? U.S. stock market's the largest, Chinese stock market's second largest. When you look at valuations, it's not close. U.S. stocks are wildly overvalued relative to Chinese equities. So I get why the propaganda exists. I don't really get why people react to it the way they do.
That makes that's some good clarification. Because I know that right now that is, China is a huge worry and kind of weighing on global markets. And then one more thing, and then I'll move over to Ross and then come back to you. I kind of want to touch on this global banking crisis earlier this year, and then the recent kind of downgrades, the recent downgrades on U.S. banks from Fitch and Moody's. So what does this mean for the U.S. and for the world? And is the banking crisis over, or is it behind us now?
It all depends on your perspective. So if you believe, as I do, that it's all part of a very long-term plan, it's just getting warmed up. In fact, part of my talk tomorrow in Chicago is about this. It's not a coincidence that the central bank, was created in 1913, right? I mean, we know exactly how it happened. J.P. Morgan fomented the famous Knickerbocker Trust run on the bank, got the law passed that changed trust law so he could, as he liked to famously quip, I like a little competition. He didn't like a lot of competition. And then, his father-in-law, his best friend's father-in-law, John D. Rockefeller's father-in-law, was Amory Aldrich, who drafted the plan to create the Federal Reserve. Well, where did they get the plan for the Federal Reserve? The same place the Bank of England got it, from the Rothschild clan that started the first central bank in the Netherlands. You think about it. How is the Netherlands the global superpower and have the world reserve currency? It's about as big as Ohio. I mean, there's just no way that should have happened. But Rothschilds were very bright. They created a way to finance wars like no one had ever seen before by printing money out of thin air, the first fiat currencies. And so half the clan left to England, set up the Bank of England. They did the same thing. Shocking that the UK became the global superpower and had the world reserve currency. And then, we created the same thing in 1913, and 31 years later, shockingly, we had the world reserve currency. So, the Fed exists to do one thing, which is to steal the wealth of the masses and give it to the few, the people that own the central bank. Remember, the Federal Reserve is neither federal nor does it have any reserves. It's actually not a bank. It doesn't have deposits. It is a private corporation owned by wealthy families around the world, most of them not American, and it exists to enrich the banks. And so the banks have a central plan, and they've been executing on it for 800 years. And it's a pretty good plan, right? They extract rents for certifying trust between parties, right? In the old days, Tracy, I would lend you money and I would write down in my book, Tracy owes me $100. And you'd come back a year later to pay me the 110. And I'd say, oh, Tracy, you know what? You owe me 220. You're like, what are you talking about? I only borrowed 100. No, Tracy says right here in my book, you owe me 220. You had no way to disprove because I had the only ledger. So the Medicis, 800 years ago, borrowed an idea from some monks, actually the Portuguese monks, the Knights Templar, the Order of Christ. And they borrowed this idea that, well, maybe, Tracy, you should keep a ledger, and Mark, you should keep a ledger. And we, the benevolent Medicis, for a small fee, will determine that the ledgers match. But here's the problem. They're corruptible. So I go to the Medicis, I say, you know what, guys, here's the deal. I'm going to write the number up to 200. I'll give you half. So you verify my number. So you come back to pay me. You say, here's your 110. I'm like, no, Tracy, you owe me 220. And you go, hey, Medicis, what the hell? And I'm like, Tracy, you must have written down the wrong number. I'm sorry, Mark's number is the right one. Well, it turns out you have this problem. If someone has to certify trust, they can extract a rent for that. But the problem is they're corruptible. So you need someone to look over their shoulder. And so you need another ledger. And it wasn't until Satoshi Nakamoto came along and created Bitcoin that you have a third permanent immutable ledger to solve this corruption problem. And the banking industry extracts $7 trillion of rents from global citizens every year for certifying trust. But now with the triple entry accounting and blockchain, we can have truth and we can substitute truth for trust. Well, they don't like that very much. So they started the attack a couple of years ago on the centralized lenders in the blockchain industry, like Voyager and Celsius and BlockFi. And then they went after, the big guy, FTX, and Sam, although I will argue he was a plant all along to foment this problem. It was really odd. The day after Luna went down a year ago, the stable coin that wasn't stable, literally Janet Yellen said, oh, we've drafted a plan to regulate stablecoins. Like in the last 12 hours, you drafted a plan, Janet? I don't think so. And then we had this thing with Silicon Valley Bank and Signature Bank and what was the other one? Silvergate. Well, literally, all these banks start to go down. Well, why did they go down? Well, ostensibly, they went down because they had a mismatch of assets and liabilities and that they had lent long and borrowed short and bought these long-term treasuries. Well, why did they buy the long-term treasuries? Well, they were forced to buy the long-term treasuries because the government couldn't sell them to the Chinese or the Japanese or the Russians because they'd pissed everybody off and they didn't have any will to stop spending. So they stuffed them down the banks. Well, that was not a problem because they're all money good if you hold them to maturity. But if you have a run on the bank, which some might argue, just like JP Morgan fomented the run on Knickerbocker Trust to get what he wanted, somebody might have fomented this run on Silicon Valley Bank because guess who bought Silicon Valley Bank? The same person who bought Washington Mutual Savings and Loan in that crisis and the same one who bought all the S&Ls in that crisis. Never waste a good crisis. It's funny. It's always JP Morgan right at the top. So, and literally the next day, Tracy, what does Janet Yellen do? After the Fed injects $300 billion to insure all the deposits, she says, maybe our banking system's not trustworthy. Maybe we need an alternative. Well, what the hell is she talking about? She's talking about central bank digital currency. And for anyone who's never watched the minute and 47 seconds of Augustin Carstens from the BIS on what a CBDC is, you need to watch it because it's the most frightening minute and 47 seconds you'll ever watch. CBDCs are pure evil. They are the plan. And this is a really long answer to your seemingly simple question. but not a simple question, a really important question. What the heck is going on with this banking crisis? Well, I will argue it's a controlled demolition of the banking system to replace it with CBDC. Not that I feel strongly about that one, by the way.
It's not frightening at all. I feel strongly about that as well, but I think you can tell that by my tweets. So, agree. So I'm going to go to Ross. I'm sorry. I'm going to go to Robert first because he's got a hard stop earlier than everybody else. So I just want to make sure that I get him in. So glad you were able to make it, Robert.
So sorry, Tracy. Can you guys hear me okay?
Oh, good. Yep, you sound great. So first, let's start with ESG and the most tragic event in Maui, where we learned that Hawaiian Electric was aware of the risk to the power lines years ago, but neglected to act in favor of ESG policy. So could you give us a little more detail on that, and what are the dangers of this? And, are there other utility companies that are doing the same thing?
Yeah, so let me preface this by saying, look, I'm an investor across the entire natural resource spectrum. Utilities are a very small part of what I do. So I am not going to be the guy who talks about, specific rate cases and the ability to pass through costs and all those sorts of things. I'm just looking at it from a person who looks at how businesses are allocating capital and what that means both for their returns and the sort of strength of their underlying businesses. There's a perception that utilities are these very safe, very sort of benign, they build generation assets. They charge enough to be able to make some sort of profit on those that they then pass on to the investors as dividend. If you actually look underneath the hood at virtually all the utilities, but particularly the utilities that are going the fastest into renewable generation assets, wind and solar, what you will see is this consistent pattern where they are outspending their cash flow by a very wide margin. Those investments are not generating returns, and so they are massively cash consuming businesses. They're paying the dividends by issuing debt. And I think it's a very different picture than I think most people have in their minds of utilities being these sort of staid, safe, very kind of between the lines sort of investment vehicles. And I think that what you have to take away from that is the dollar that is spent on low return projects, which by definition, the things that are happening in wind and solar are lower return. And in fact, the returns are deteriorating over time because they were originally presented to utilities under the premise of the assets would last longer than they actually do. The assets would require less maintenance than they actually do. And so the entire economic model that said these are 3, 4, 5% rate of return assets has been proven false. And so if you're investing capital in a way that is not generating returns, that takes capital away from other parts of your businesses. And I think that is a story of PG&E here in California, and the story for Hawaiian Electric and many other utilities, in that if they're scrimping anywhere, it's on the upkeep and maintenance of their existing systems. And so what you're adding is not only vulnerability in terms of their ability to provide power at any given time, because you're replacing baseload with sort of variable and intermittent power, but also the financial vulnerability of sort of neglecting to maintain the integrity of your existing system, which leaves you more vulnerable to these catastrophic events.
Absolutely. And then moving on, you mentioned in your recent investor letter that you believe inflation rates will remain well above the Fed's magical 2% level, which I kind of tend to agree with. But so what does this mean for investors? What assets should we be looking at, or what scenario does this favor when investors are looking at assets to get involved in?
Yeah, look, if I'm right, what you want are things that cannot be printed or cannot be sort of manipulated into existence. And look, I'm a guy who sells hammers, so I'm gonna tell you you need to own hammers. But the way that we have chosen to express that is sort of what I would consider a real world tip. If you invest in a tip security, what you are getting is an income stream that the government tells you what the rate of inflation is and therefore what that income payment will be. I consider a real world tip sort of natural resource companies around the world investing in real hard assets that you can't print into existence, specifically ones where management teams are highly geared towards returning that capital to investors. And one of the great, for my investment purposes, one of the great byproducts of ESG is the shaming of all the traditional resource companies in the world, the exclusion of them from the broader institutional investment palette, which means they have decided they don't need to grow. They are just going to return capital. So suddenly you can create this high single, low double digit income generating sort of portfolio based on real assets that will depreciate. And Mark's commentary, which I caught the very back end of, which is, look, the plan is inflation. There's too much in debt for the plan not to be inflation. They'll give lip service to doing other things. The way we've chosen to express that is by what we consider real world tips in these huge real asset commodity and resource cash generating companies. And to me, they're egregiously cheap relative to history. They're one of the few pockets of value in the market. We're buying things at 2, 3, 4 times cash flow and double digit dividend yields. And the market is choosing for now to continue to trade those at depressed multiples. I'm not sure that will always be the case.
And that leads me, obviously, we need to talk about, that leads me to oil and gas talk, really, because global recession fears basically plagued this market for the greater portion of this year, even as we've seen global consumption rise to an all-time high, over 103 million barrels a day. So what is going on in this market? What are investors not seeing, particularly in the equities?
Yeah. So look, so energy stocks have re-rated a little bit over the last year. The cash flow multiples have come up a little bit. What they were really priced as, if you looked back, a year and a half ago, end of 2021, resource equities were priced as very short duration options with a negative skew. The narrative was that these companies would be, it's a declining business. We're going to be, fully transitioned to EVs by 2030. The politicians were spewing what, utterly unrealistic targets, but the investment markets were taking them at face value. So over the last year, even though oil prices have come down, energy stocks have done okay. And that's because what you've done is effectively taken what was priced as a short duration negative skew option and given it a slightly longer duration and maybe flatten the skew out a little bit. So apologies for a little bit of excessive options parlance, but that's really the way that I viewed it and sort of the framework by which I laid out a couple of years ago why we thought energy was an interesting place to invest. The big change and why we think that energy should be going to something priced with a positive skew as opposed to a negative skew is that the entire structure of the oil market has changed. It used to be that resource companies and energy companies in particular would blow their brains out every time oil prices went high. That is not the case anymore because ESG is telling them we don't want you to, we're not going to pay you for it. The addition to that is that every time there was a significant break in the economy or downward momentum in oil prices, the OPEC in general and Saudi in particular would increase oil production into the decline in demand, and that created a shock on the downside. Now, why did they do that? It served their purpose because if you throw a big shock at the oil market every 5 to 7 years, the capital is slower to return there. So they keep larger market share for longer. The Saudis now realize they don't have to do that. And so the Saudis are now in a position where they extract barrels when demand weakens. And so what you've got is instead of having sort of this accentuating factor on the downside, you have a buffering factor on the downside. Now, agreed, that caps our upside a little bit in that production can come back at 100 or 115 or $125 a barrel. But what you've created is like a really healthy return environment for the oil companies where, kind of 70 is the low side, probably 100 to 110 is the upside, but they can generate amazing returns, return capital to investors, to pay down debt, buy back their stock, and reduce share counts when the entire rest of the market is expanding theirs. And it creates some really interesting positive flow dynamics that I think are really good. So that's not to say they're bulletproof going into what is likely a recession, but they're much more resilient and much more durable than they have been in years past.
I'm all for it. And then before going on to Ross, just want to ask you one more question in case I don't get any more questions in with you, because I know you have a stop. Kind of wanted to talk about gold a little bit. We've rarely talked about gold on this spaces before. And, there's a big disconnect between, say, the gold ETFs and miners versus central bank demand. So what are you seeing in this market and your overall thesis as to why you think this asset is important and maybe misunderstood?
Okay, yeah, I'll make this quick so we can get back to the other presenters. But there are a lot of questions. People look at gold for different reasons. There are a lot of different reasons people think they should own gold: inflation, deflation, monetary debasement. I really go back to the Jim Grant theory of gold, which is it is a put on central banker confidence in central banks and their ability to actually achieve the goals that they want to achieve with the tools at their disposal. And so I think last year was kind of a perfect example. Big inflationary year. Everyone was looking for gold to do well. I actually thought a flat gold price in US dollars was a really good performance, given the strength of the dollar. And given the fact that the market seemed to consistently give the Fed the benefit of the doubt that they would be able to get inflation under control. And that's why sort of the back end of what the expected curve, yield curve looked like was consistently coming back down. They were giving the market the benefit, giving the Fed the benefit of the doubt. And in fact, if you were a non-US dollar holder of gold, you were up anywhere from 5 to 20% last year. So fantastic performance in a year where the classic 60-40 portfolio got totally smoked. So gold stocks did compress because they are a second derivative on that. I actually really like the gold sector right now. I came into this business in the 1990s. And when I was at the Franklin Templeton Group, we had a big gold fund, and gold stocks were traded at 2 times NAV and 12 to 14 times cash flow because they represented optionality. They represented optionality on an inflationary outcome. And investors were willing to pay something for that, with the memory of the 1970s and even parts of the early 1990s still very sort of fresh in their minds. Now we're sort of this is straw hats, not in the wintertime, but straw hats in the beginning of spring, where the thing that protects you against the inflationary outcome with the most convexity, which I think are gold stocks, are priced as cheaply as they ever have been. You can buy these things at 10 or 12% free cash flow yields, 3 to 5 times cash flow, significant discounts to the market where they used to trade at premiums. So for that reason, I think the gold stocks, they're going to be a wild ride and they're not going to do what you want them to do over the short term. But I think gold stocks are a very logical allocation here.
Thank you very much. Now, moving on to Ross. Sorry. So first, let's talk about overall the global PMI. PMI came out in Europe and the U.S. today. So I'm going to use that question first because it's the newest piece of information that we have. Global PMIs are obviously slowing. Europe was terrible. U.S. PMIs came out showing softer demand, particularly from Europe. And so I wanted to kind of talk about how is this showing up in shipping, if so, and what should we expect a huge slowdown, especially, I know that looking at the people in this spaces, there are a lot of people that invest in shipping stocks here. So how is this affecting it? Are we seeing a huge decrease in shipping? And, what does this all really mean?
Yeah, it's we're at a really interesting time in talking about the maritime sector in particular, where we've got these very sort of positive, hopeful signals on some side, depending on your perspective. And then we also have some pretty bright, glaring warning signs. In general, the ocean carriers on the containerized side have done pretty much everything they can to limit capacity or to right-size capacity in the market. We hit an extremely low spot rate here about 2 months ago, from Asia into the U.S. West Coast, into the U.S. East Coast, and with taking ships out of the service strings, reorienting their vessel strings, the labor, potential for labor disruptions, the ongoing labor disruptions at the Canadian West Coast ports. They've been able to manage to kind of flatline or even increase spot rates over the last 30 to 60 days. But there's a limit to how much that can go. Real demand will have to actually pick back up at a substantial level to be able to drive ocean freight rates higher, back maybe to more what we were seeing in the early part of this year or the late part of last year. We're half the price or more of where we were roughly to North America last year, as well as Asia to Europe. So in general, global ocean freight rates on the containerized side are very much pegged to how is China doing as a manufacturing engine, because really all the global container capacity is kind of built around that. If China's exporting more, if it's cheaper and easier to get things out of China, China's 19-20% of global manufacturing capacity for physical things. That plays an enormous role in shaping what the market looks like. The U.S. is still highly consumptive. We're an import-driven economy in a lot of ways. My own personal feelings on that notwithstanding, it is the reality. So we have certainly seen container freight tick back up over the last couple of months. It did very much bottom out. But the unknown on the other side of that is really what does it look like with the kind of constant fear, slow burning beneath the surface of importers, exporters, and maritime carriers of potential disruption between China and Taiwan. That's a big deal. One of the other big issues that we're continuing to see is companies here in the U.S. in particular, since we're such a major demand driver for maritime shipping. What does it look like when companies, are trying to get inventory levels right? They've been over-ordered for a year. That's part of the demand spike that we're seeing as companies finally bled through inventory or find a way to dispose of it. And they're coming back and manufacturing again what they need, but not at the same levels as we saw during the pandemic. So we do have some real uncertainty. And if you're sort of stock watching the various shipping companies, at least the ones like Zim, that are traded publicly in some way, you have to really be sensitive to the fact that as much as there are some good indicators, those good indicators in some ways are surface deep, because the rally in capacity, the rally in pricing that we've seen is largely tied to the fact that they're laying up iron and hiding containers in depots throughout Asia and throughout North America and Europe, rather than there being an actual significant demand spike in new production and inventories. On the bulk side, bulk rates have been tacking down pretty substantially, tied, of course, very much to what does it look like when countries, reduce or increase their trade in large volume physical commodities with one another. And here again, China in a lot of ways, particularly on the dry side and the break bulk side, is going to be sort of the determining factor of what rates look like and where capacity is at. Today, when they're in stockpiling mode for certain physical things, you'll see rates look somewhat strong. But here again, ship owners have the ability, crews have the ability to sort of select against risk to the extent they need to. It's a trade-off. And we're one, impolitical comment or one calculated or inadvertent misunderstanding away from things going absolutely haywire in the maritime industry. That does open up a lot of opportunity. The U.S. needs to do a substantial increases, substantial emphasis on domestic shipbuilding. What does that look like? Pivoting away from the binary Jones Act versus naval shipbuilding capacity. There is a better way to reimagine how we do shipbuilding in the U.S. and how we reinvigorate our maritime sector and keep a little bit more, of what the future state of play looks like in our own control. But to this point, we're not really doing that. Short term, my gut here is that we will continue to see little bits of rate increase, maybe another couple of, general rate increases on the container side stick going to the West Coast, East Coast, and into Europe. But there's a ceiling to what we can do. And really, Panama Canal is kind of the only thing that we're looking at short term that can really kind of reshape the state of play, short of some sort of, if not black swan event, at least highly unpredictable on when it's going to happen event, like a kinetic conflict or some other conflict in the South China Sea or between Taiwan and China.
And since you brought up the Panama Canal,
Sure.
let's talk a little bit about the backlog that's happening there right now, and what does this mean for global supply chains, and also, how much is this going to impact the cost of goods, being that it costs money every day for these, these vessels that are delayed?
Yeah, so you'll typically see at a consumer level the impact. Something like this is 90 to 150 days kind of down the line. Something as a ship that's stuck at the Panama Canal right now that most of them are showing up with appointments, and the ones that have appointments, they're transiting about 6 to 8 fewer vessels a day. I think it was the last numbers I saw here in the last 48 hours. But that adds up when you have when you have 30, 40, 50 ships kind of all arriving on the Atlantic and Pacific sides at any given time. So they are transiting as fast as they can, but when you're talking about a very water level sensitive setup like the Panama Canal, particularly with the Neo Panamax size vessels and the new locks that they built here in the last few years, it's a significant impact in the sense of the East Coast has long been, and the Gulf Coast to some extent, has long been the safety valve for West Coast congestion. We're seeing a lot more ships running into that were put on the water in the last 60 days to try to get through the Panama Canal and risk that because of the threat of disruption at the West Coast. So we're seeing a few things kind of coming together at once. And really the only thing that kind of fixes that is either a slowdown in demand to transit the canal or water levels getting back to where they need to be. And that's a seasonality thing. We'll need to see a lot more rain and a lot more reduction in traffic kind of happening simultaneously in order for that, that bottleneck to clear anytime soon. The carriers do have the optionality to switch their ships out or to rotate their larger vessels, the 12 and 13,000 TEU vessels that go through the larger canals and or larger locks in the canal. They can rotate them into the West Coast of Mexico or the US or Canada. But here again, you run the risk of then increasing congestion, particularly on rail. A lot of what comes to the West Coast is bound for the interior. It's going into Chicago, it's going into Kansas City or Memphis, Dallas, Omaha, coming over the West Coast like that. And the ships and the ability to discharge the ships are not the issue. The issue is that there's not enough railroad capacity, which we saw during the pandemic was the original backup. It wasn't the ships on water and the ability to stow or destow them at the port itself. It was the ability to move containers off the dock and get them into the interior, which is where, on an IPI basis, where they're being called for. So any real solution to alleviate congestion, particularly going Pacific to Atlantic side at the canal, will involve potentially creating more problems and backlogs at, the West Coast ports of the Americas.
And then you also mentioned about we had this buildup of inventory that we had to burn through retailers and such in the United States. So I kind of wanted to ask about trucking capacity, because, we saw some figures out from Sonar, FreightWave Sonar, and it said, trucking capacity is finally reacting to higher freight volumes. Tender rejections were at the highest levels at 3.96%. So does this tell us that perhaps the bottom is in the freight market and that things might firm from here? So obviously, that would be good news for diesel markets.
Yeah, it's the interesting thing about where we're at with trucking capacity is, of course, as I'm, singing a song a little bit of, well, we're kind of, we're kind of flattening out a little bit on the import side. It is true we were at a higher level for July. August looks to be kind of roughly the same. On the trucking market side, though, it's not just sensitive to retail inventories that need to move, but it's also going to be sensitive to things like fuel prices, driver capacity, all sorts of other things. And I think we've seen, my gut here is that we saw with all of the crisis going on with yellow, and what do we do there? And then, of course, the uncertainty with UPS and its union driver fleet as well. We were looking at, and certainly the companies that I, work closely with and advise to, there was enough uncertainty that people were switching away from LTL. They were, they've been making plans to do more milk runs. They've been making plans to do more long haul consolidated type of operations instead of relying on LTL carriers, because they wanted to see where things shook out in terms of rates, in terms of capacity. Now that we've, I think we've kind of seen that it's maybe not so bad. The market really absorbed it. But we saw that capacity, that was inside LTL, or that demand that was inside the LTLs. I think shippers found a different way to move a lot of their freight. And then that's bullish, of course, for trucking companies and truck drivers, particularly those that specialize in things like reefer, or specialize in flatbed, specialize in dry van, as opposed to, an LTL mode. So the velocity and the quantity of movement of goods inside the U.S. is certainly an encouraging indicator, but I think we're probably 60 to 90 days away, particularly as we get into import season. We're in the middle of, entering peak season. Inventories are going to be building, theoretically, at least for ahead of Black Friday and Christmas shopping and coming into the fall season. So if we see imports continue to rise or stabilize at a higher level, and we're continuing to see capacity in the trucking market limited, rejections are up, which means, the carriers and drivers have options, then we can probably feel a little bit better about where we're going to be. But, I think interest rates, economic and political uncertainty will keep a lid on things to a certain extent as well.
And I think Robert had a question for you.
Absolutely. Really appreciate that rundown. One of the things that I've been trying to get my arms around, and tankers and shipping is something that we do, as an aside, but not our core business. Given the sort of contraction of global shipyard capacity to build new boats and the rush to build new container ships and also LNG tankers over the last couple of years, kind of tying up, to my understanding, a big portion of that shipyard capacity. What's the ability of the industry, and I'd say more specifically in sort of both the dirty and clean tanker markets, what's their ability to react to higher rates to add capacity? Because, it used to be that every time rates go up, past 50 or 60 grand a day, that, you'd have the mom and pops start building ships and they'd blow themselves out of the water quickly. But what's your understanding of where we stand in the ability to add capacity?
Yeah, it's when we look at what the order book looked like from 2019 and then going into 2020, and then all of a sudden, late 2020, it to those of us in the industry that were kind of paying attention, it didn't surprise us, but it caught a lot of other people by surprise when the demand just surged the way it did in late 2020. Stimulus bucks had a magical, effect on a lot of things, in terms of the construction, transportation, and supply chain industries. And maritime shipbuilding was, of course, not immune to that. Suddenly you had carriers that were limping along with older fleets in a lot of cases. They've been wanting to build these much larger ships where they can do more volume, that they can slow steam, so they can carry more capacity at roughly the same fuel cost per ton. But they, weren't able to build those and have an excuse. And then suddenly the pandemic came along and the surge in transportation of physical goods. And the bottlenecks allowed them to justify driving rates insanely high. I mean, you're talking $25,000, $27,000 for a 40-foot container in Minneapolis or Chicago or Kansas City. It was absurd. Those rates today are hovering between, $3,300 and $4,000. So the carriers, I think, got very fat very quickly. They put big order books on for much larger ships because they were planning to add one large ship and life cycle two out, or scrap them, or sell them into, regional carrier fleets, whatever it might be. And now they're kind of stuck. They're stuck with these ships that are half built. They've got very dense order books. The shipyards, in a lot of cases, are going to be building more of these ships. Same for the tanker side. And the question is what happens when this excess capacity of used vessels hits the market? And do they scrap? Do you see an expansion of, regional or interline or cabotage type fleets that takes advantage of all of this iron hitting the market at roughly the same 2 or 3 year period? Or are they going to be canceling some of their new builds that are maybe the third or fourth ships of the line in the newer, larger fleets? The uncertainty really is going to be who blinks first, or the shipyard's going to say, heck no, you put your orders on, and by God, we're going to jam them down your throat. And then now we have fewer, larger ships in a lot of cases, in a lot of different modes, that have a more limited routing availability, more different crewing requirements, and are not able to maybe transit certain, choke points that we have in the world, or are not optimized for the way global trade is shifted during the time it takes to build a ship, that 24 to 36 month window. So that's really where the unknowns are, is going to be is the world looks very different today than it did 2 years ago for the shipbuilders and for the carriers. And it's going to look very different, 24 months from now, when a lot of these are starting to hit the market. My gut is that they're going to try to continue to keep capacity as tight as possible, so that they don't have to float rates with variability in demand, which has historically always been what carriers have had to do. I would say we're going to continue to see vessel sharing alliances be very important to them as a pricing and optimization strategy. I would also say that we're going to see more vessel sharing alliances worldwide probably become more like a cartel than any of us want to admit openly. And so to the extent they're able to cartelize, maintain the oligopoly status, and utilize VSAs to essentially lock rates at a permanently higher level, that's going to really be up to some of the global regulatory bodies, particularly Federal Maritime Commission, which I know John Conrad was on here earlier, G Captain, and he and I share a very similar cynical view about FMC's willingness and ability to regulate at scale. So we're, not in unknown territory here, but we're certainly in decision point territory for a lot of the carriers that half of their ships are built or half built, and they're looking at what happens when they need to put these things on the water and start putting them to use financially. I hope that answered your question, Robert. I apologize if it did.
No, that was great. Thank you.
All right, so I know Mark and Robert now have a hard stop at noon, and we're running out of time. So back to Mark really quickly, because I can't talk to you without talking Bitcoin, right? And so just quickly, I know this is a big question, but this asset seems to have more emotions tied to it than any other I've seen. People either love it or hate it. So can you just give us a brief overview? This is very difficult.
Well, I mean, brief is hard, but I also don't do short well. No, it actually is really, really simple and really brief. And we talked about it earlier on triple entry accounting. Triple entry accounting is the important innovation of this century, maybe even of the millennium. And it's a big deal. And Bitcoin is simply a use case of blockchain technology. It's essentially playing the role of digital gold. Gold is the only money that exists in the world. Money is an asset that exists in the absence of liability. And gold has been that for 5,000 years. Today, we don't need a physical version. We can have this digital version that is scarce, not replicable, and I believe will essentially become that base layer of money. Currency is built on top of that through government debt, but the only money that exists in the world is gold. So Bitcoin is simply this innovation around technology that solved that corruption problem, in that, we had to have the Medicis looking over our shoulder when we had a transaction, and then we had to have someone looking over the Medici's shoulder, and then we had to have someone looking over their shoulder. Well, consensus algorithm solves that for everybody. So, all the emotion around Bitcoin, I think, just comes down to you've either spent the time to understand what blockchain technology is and what it does, or you haven't. And that's okay. Most people are late arrivers to every technological innovation. And just a couple quick things. One, you can judge the quality of an idea by the quality of its detractors, right? If people we didn't know or didn't care about didn't like Bitcoin, who cares? If some of those powerful people in the world don't like it, it's probably a big deal. The fact that one of the most powerful people in the world, you may not like him, Larry Fink, but he runs one of the largest asset managers in the world. The fact that he went from calling it an index of money laundering to something that everyone should own some, as long as they buy it from him, to protect themselves against currency devaluation on CNBC. It's a pretty big deal. So short version is it is a better form of money than gold because it's more divisible, it's more portable, it's lighter weight in banking situations. And ultimately, I think it will be that base layer of money. So I could go on and on and on, but I told you I don't do short well.
That's all right. All right. And do you have any, I usually do a final thoughts round. Do you have any final thoughts, something that we haven't talked about that you want to talk about, or what should we be particularly paying close attention to as investors over the next, say, 12 to 24 months?
No, follow you and people like you that focus on real assets. I think maybe Rob said, focus on things that central governments and particularly the Fed and other central banks can't print. I think all the advice today on logistics and real assets is really well founded. I mean, at the end of the day, people think stocks are making all-time highs. It's only because we denominate stocks in toilet paper. If you look at stocks denominated in gold, they're the same price today. The S&P 500 is the same price today, denominated in gold, as it was in 1997. It's just money illusion. And, you see this in every dictator playbook in the history of mankind. The best performing stock market in the late 2000s was Zimbabwe, right before, they went to $100 trillion Zimbabwe dollar bill, which wouldn't buy a loaf of bread. Best performing stock market 3 of the past 4 years was Venezuela, where they took the Bolivar down 99.99999%. So when you reach this point where governments are backed into a corner and there is no way out other than to devalue their currency, they will devalue their currency. And that's why Larry Fink, one of the most powerful people in the world, got on television and said, yeah, you should probably own some Bitcoin to protect yourself against that. But you can own gold and oil and other stuff, shipping containers, et cetera. So just follow you, Tracy, and everyone will be fine.
Thanks.
I totally agree with that sentiment and would say that, look, I think a lot of people in the resource business tend to be anti-Bitcoin, and sometimes the Bitcoin folks are anti-gold. The stack of fiat out there is plenty large enough for both traditional real assets, particularly ones generating cash flow, and digital currencies, Bitcoin in particular, to win. It doesn't have to be an either or. So I think smart investors will consider both in terms of how they're allocating capital today.
And your final thoughts, Robert?
I think you've covered it all really well. I'm very sorry for having arrived late. It was a first day of school issue, which unfortunately popped up. But look, I really appreciate all the spaces that you do.
It's all right, Rob. We'll just call you LIFO from now on.
Exactly. But really appreciate what you and gosh, the sort of energy and resource community has been so good at sort of bringing up issues in a really thoughtful way. And I just think the more we continue the dialogue, the better solutions we get to.
Excellent. Thank you. And I still have so many more questions, so I definitely want everybody on this panel again. And Ross, I'm not done with you yet. Follow everybody up here. Mark had to go. Ross, I'm not done with you yet.
I am here.
If you give me a few more minutes.
No, you're good.
All right, cool. And just a couple more minutes. So really, I have two fun questions. One, I have to ask your thoughts on this new Cargill ship with these metal wind wings, and how much fuel savings do you think there really is?
Man, it's hard to tell, and then I really had to chuckle when I saw the press release and some of the stories about it, where everything old is new again, and in this particular case, it's driven by a lot of climate change discussion and ESG impact and all these other things, and so we're again looking to Mother Nature to help resolve a lot of our issues. If we're talking about a truly hybrid thing, and certainly I'll leave the engineering and sort of the physics components of it to people like John Conrad or Sam Macaulay-Anna, but my view is that it will likely result in being, if anything, maybe iterative or slightly evolutionary as opposed to revolutionary or counter-revolutionary, if we're kind of going back to the past on this. It's certainly not an unknown concept of hybrid sail and powered boat. A lot of boats are that way. Now we're just talking about scaling up the vessel size, but there's also a reason that our aircraft carriers don't have sails on them too. And you're talking about the reliability. You're talking about losing space in the design of the vessel. You're talking about an ability to berth, or can it berth? Can it discharge and load cargoes as efficiently and with existing infrastructure? So there's a lot of little things. I think it's interesting in the sense of a lot of things are mechanically interesting that maybe aren't practical or feasible. But at the end of the day, it's never a bad thing to be talking about what innovation is out there, as we look forward, if we have to look back to the past at the way things were done before. But I don't think it's going to be certainly a widely adopted technology in the next 50 years. We're very unlikely to go back to the age of sail. In fact, I think that on the one hand, I think innovation is good. I think talking about these things is good that are out on the bleeding edge or the cutting edge. But I also think that there's a part of me, maybe the pirate flag mentality of, why aren't we mocking that and tearing it down a little bit as an idea and talking about the benefits instead of powering ships with small, medium-sized nuclear reactors? Why aren't we talking about the fact that prototypes and capabilities exist to do this, and engineering a revolution and global maritime trade, particularly as the United States and Europe working together to build and design and launch and operate new types of vessels that can do things that maybe we've never done before because they've never had power plants available to them that could output that sort of load. If we've been operating nuclear powered naval vessels worldwide for many, many years without any safety concerns. I don't see why we couldn't do the same for the commercial sector and really reimagine our own relationship with how we do global trade on the water. That to me would be a far more interesting and compelling thing really to look at than Cargill putting some sails on ships, whether it's a gimmick or, a proof of concept.
Very true. Thank you for answering that thoughtfully. I appreciate it. So really, I kind of want to talk about, what should we as investors particularly be focusing on in this sector right now? I mean, I know that's a difficult question, but for the people that are invested in logistics, and that is a lot of people that are invested in trucking companies or container companies or tanker companies. So, but what are the things? And this, I know it's kind of hard to nail down exactly what we should be looking at, but when we're evaluating this particular sector, what do you think are the things we need to focus on the most? Right now, and say from now, say over the next 12, 24 months per se.
Yeah. So if you're looking at from an investment standpoint, again, of course, the standard disclaimers, apply here as far as, I'm not an investment professional, license, et cetera. But, the very simple sort of first principle I follow is that logistics is a map of human action. So a map of human intent. Depending on which side you're looking at it from. So if I wanted to know which sectors or which specific companies are more likely to pop or more likely to be moving in such a way that I could position myself for maximum profitability, or if, that's not the goal, maybe it's securing my portfolio and having a more stable foundation. Logistics is highly volatile for a reason. And it's because it's very, very price driven. Even when you're talking about long-term, charter rates on ships, and you're talking about, fairly known pricing, and we have indices and spot rates that we can follow and things like that. But there is a volatility to it because in a lot of ways, shipping is largely very fungible in the sense of I can choose to ship with Maersk today. I can choose to ship with Zim tomorrow and then CMA the day following, depending on who's got the best rates. So if you're trying to micro target based on, down to a per company basis, particularly those that have worldwide exposure, it can be somewhat tough to say when the stock is going to rally or when it's going to decline. And market sentiment's weird because for the most part, people engaged in the markets don't know the first freaking thing about logistics and shipping and what the industry is really like at a granular level. People that watch ships and understand Incoterms were seeing 3 and 4 months ahead of the Russian invasion of Ukraine. Something very weird was happening because all of a sudden the Incoterms had completely flipped and the risk profile was suddenly on, the exporters. They were having to put ships in there and take the risk of something happening to that ship with goods on water, whereas before it was the opposite. So people who kind of watch this stuff at a very micro level, a very granular level, because they're in it day to day operationally, like I am, we take a different perspective on, how we would target. Broadly speaking, if you're looking at the transport of, if you're wanting to look at what is probably going to happen with container shipping, then you would want to look at PMI. You'd want to look at, output of manufactured goods by region. If you want to get a little bit more subtle and see where some of these carriers have more exposure or less exposure, you'd be able to look at capacity by vessel string. That data is available out there. You'd be able to look at data on, which port pairs in particular seem to be increasing in conjunction with more traffic or less, decreasing with less traffic. But at the end of the day, you also want to watch the larger regional trends of what is being produced and where is it going. And depending on what goods are being produced and depending on the friendliness of these nations, if the BRICS are dead serious about banging their faces against the wall and increasing in the physical trade of raw materials, then you're going to see, as we would expect, more soybeans going from, shifting from U.S. sourcing by Chinese buyers to Brazilian sourcing. They're more available. Corn's the same way. If you're wanting to look at, trading coking coal or trade in, finished steel or aluminum, whatever it may be, at the end of the day, logistics is downstream from people's intentions and from actions and agreements. Dollars are going to change hands. Political agreements are going to change hands long before a ship ever gets on water. And so, for me, certainly, I've kind of rarely been on the wrong side. I'm not going to say stock-wise, but rarely been on the wrong side of the larger macro trends in the last 10 years as far as positioning, customers or employers or wherever I'm at that time for success in shipping and kind of running ahead of where the trends are simply by paying very, very close attention to what's happening between the stakeholders that are happening all the way upstream in the transaction. Usually that's going to be state level entities and enterprises, or it's going to be their appendant bodies and the financial and regulatory enablers. What are they doing? What are they saying? And then what is the downstream impact going to be on a more regionalized or industry specific basis?
And since you brought up the Russian invasion of Ukraine, that leads me to my last question is, since this Russian-Ukraine Black Sea deal, or whatever you want to call it, has come to an end, have we seen any major shipping trends coming from this?
Well, we did see. Yeah, no, it's a good question, Tracy. So we did see the first container ship that I had been stuck in Odessa for quite a long time, maybe even since the beginning of the invasion. We did see it, Ukraine kind of declared a humanitarian shipping corridor, if you will, that ran along the coastlines of the far western part of the Black Sea. And, to the extent that we see deal, no deal I have my thoughts on this. I think that the U.S. has a more expanded role that it needs to play. Certainly the access to the Black Sea is controlled by what is someone is ostensibly a NATO ally of the U.S., although Turkey's not always proven to be the most reliable ally from a national security side. And right now, Turkey is kind of controlling the flow of things in and out of the Black Sea to further its own interests ahead of regional stability or what's kind of good for global markets and the global economy and global humanitarian efforts. So yeah, there is a huge amount of raw physical commodities that are still kind of bottled up in the Black Sea region because they can't get out. And to the extent that basically you're talking about the personal goals and ambitions of really three men, being Erdogan, Putin, and Zelensky, and how they choose to operate and how they choose to interact with one another. Is a humanitarian corridor that runs along the Romanian-Bulgarian coast kind of the answer? I don't know, because the calculus is Putin going to observe that? Well, to this point, we haven't seen that. To this point, we've seen Putin kind of just do what Putin's going to do. And so there's a level of unpredictability there of every solution that potentially comes up. Is it going to get shut down? We don't know, right? So the certainly we have seen in the last year and a half since the beginning of all of this, the butterfly effect has been reduced stocks of grain available to the global market. We've seen more of a trickle or flow of Ukrainian, in particular Ukrainian ag commodities hitting the global market or being available. Shipping it out through the Danube River is only a solution that's as scalable as the water levels and available, barge and river vessel capacity. So there has to be an answer at some point. In my view, the answer is that Turkey makes a diplomatic request to have U.S. naval assets or NATO fleets there, just to kind of help keep the peace. And if there's if we've established a humanitarian corridor, then let NATO or U.S. forces take a bit of a role, not a provocative role, but a role, if you will, in ensuring some stability in that region and allowing some amount of trade to resume. I don't know that that's going to happen, but again, I don't know the inner workings of the minds of some of these actors that are involved. So we're still in unknown territory here. We can clearly see Ukraine and the West trying to figure out a solution. I just don't know that the solutions that they figure out are going to be in any way enduring or scalable.
Yeah, I mean, that makes a lot of sense, obviously. And then you get a final thoughts question as well. So what are your final thoughts for today? You can talk about something we haven't talked about, or what we should be looking at going forward.
Yeah, so two kind of related final thoughts. But the longer one is simply this: is that, in my view, the next 12 to 24 months of American economic progress or regression, or however we maybe want to look at it, is going to be determined by the nature in which the somewhat ongoing decoupling of U.S. and Chinese supply chains and the deep entanglement of interest that we have at all levels, economic, political, financial, top to bottom, really. To what extent that is accelerated or decelerated by the congressional and presidential races upcoming. Certainly, it's going to be very, very, very interesting. Which candidates, some that have historically been very friendly to Chinese interests. Doug Burgum from North Dakota comes to mind as someone who kind of threw open the floodgates and sold his state to the Chinese top to bottom. That's stopped, but it took a lot of effort to do that. Or is it going to be someone like maybe a Ron DeSantis or Trump that has taken more loud oppositional stances, regardless of what policy may or may not have been. So to what extent that drives sentiment for doing business with China over the next 12 to 24 months, I think is going to kind of be the story of our economy in a lot of ways. The shorter last thought is that, and I borrowed this from Adam Townsend. He said it years ago, was never short America. I do firmly believe that there is something very unique and special about the American cultural character going all the way back to our foundation. I don't believe that that's lost as, hopeless or as stupid as it may seem at times, the decisions that maybe we make as a country politically and as a body politic. But I do think that there is a resurgence already building, a real dynamism. And, I'm one of millions of people probably that's a part of that and working on projects and pursuing projects and kind of putting my money where my mouth is in that regard. So I'm very long on America's ability to reassert itself as a maritime power, as a supply chain power, as an energy power, as a financial power. I don't think that we're in the terminal phase of decline here. But I do think that short term, it's going to be a pretty wild and woolly and dynamic ride while we kind of sort through what this disentanglement really of the last 50 years of our economy with other economies, what that looks like. But yeah, never short America, in my view.
All right. And with that, thank you very much. Thank you, everybody, for attending today. Follow all of the speakers that were on the spaces today. They're all amazing and post a lot of very good information. Obviously, follow Place Your Trades, see what else we have going on. We have some new exciting things going on. There's going to be a little bit of a change, so we'll look forward to that. And with that, again, thank you, Ross, and thank you to Mark and Robert, who had to go, for your time today. We really appreciate it. And we will see you guys next Wednesday.